I'm Matt Crowley with Venture Capital Press. This webinar we're going to talk about our buyer in an acquisition and talk about diligencing the buyer as opposed to the buyer diligencing us. So why on earth would you ever dig into the buyer situation? Well, for a whole host of reasons, most of which relate to, does the buyer have the money? And if something goes wrong on our transaction after we sell our business to the buyer, will we have anyone to go back to try and get our business back or to get money? So here's the scenario that I think about when I think about diligencing a buyer. In a perfect world, the buyer of our business is going to write a check for 100% of the money that they agreed to pay. We're going to get that check at closing, walk away, and never see them again. That would be awesome. However, that's not how most acquisitions work. Instead, what will happen is the buyer will want to pay us less than 100%, maybe 50% at closing, and the other 50% a year from now. The year from now could be they don't believe our revenue projections. They think they're a little too rosy. And if the revenue actually shows up, they'll pay us. If the revenue doesn't show up, they'll either pay us nothing or they'll pay us less. Or it doesn't matter what our revenue is. They just don't want to pay 100% on day one. And they would like us as the seller to basically finance them by agreeing that they don't have to pay 100% on day one. They could pay 50 and 25% next year and 25% the year after that. That's all well and fine, but what happens if the money doesn't show up on the next payment? Then we're in trouble, because what we just did is we sold a business that we thought we were getting $10 million for $5 million, and they never pay us. So we could try to sue them, but at that point, the damage is already done, and it would have been better if we had found out a little bit more about the buyer before we got started. So sometimes what a seller will do is they will ask for some diligence on the buyer. And one of the simplest things we could do is to ask for financial statements. If the buyer can show us that, hey, we're a $1 billion business, we have more cash than you have revenue, then we can trust that they're probably going to be able to finance this deal. Or if they took out a loan from Bank of America or Wells Fargo specifically for this transaction, and we see the proceeds arrived, that could work. Maybe we could at least see a bank balance to know that they have the money. Those are all things that we could do to help ourselves out. Also, if we know that the buyer has a major financial backer, maybe it's owned by a gigantic multi-billion-dollar private equity firm, and they don't have a track record of screwing over the sellers of businesses to their portfolio companies, maybe that's okay. So there are lots of ways from a financial standpoint we could get the information we need. If our buyer is a publicly listed company on the stock exchanges, maybe we could get some information on them by just looking at what's publicly available at the SEC, or for that matter on Yahoo Finance. If we know that their company's not in trouble, that they're growing, we can see what their publicly provided financial statements are. We may not even have to ask the buyer for anything beyond what they already tell Joe Q Public. Those would all be good things to know. We might need more than financial statements if a buyer is offering us not just cash. Sometimes the buyer will say, we'd like you to be partners with us, and we'll fold your business into ours, but we'll share some of the upside with you. We'll pay you $10 a share in cash, but we'll also give you half a share of Chevron stock when Chevron's looking to buy you. So now you have an extra lottery ticket. Well, if that's the case, then now I need to know, how healthy is Chevron? Because guess what? By taking some of the buyer's stock, I just became an investor in the buyer. So if the buyer really is Chevron, again, you're going to look at their publicly available filings with the SEC. But if the buyer is instead Crowley Corporation, you have no idea if my stock is worth anything. Maybe it's worth nothing. So not only do you want to see my financial statements, but you need to understand my business. If I'm going to give you 20% of the shares of Crowley Corporation, you're going to be a significant investor. So now you want to know, Well, does Crowley Corporation have litigation that I should know about? Does Crowley Corporation have good relationships with its customers, with its vendors? And by the time you're done, the due diligence checklist that the buyer gave to you to try to understand your business as the seller, you may hand them a due diligence checklist that looks suspiciously similar, because you need to ask all those same questions for yourself. Now, that means that your costs are going to go up as a seller, because now your finance team, your accountants, your lawyers are going to diligence the buyer. So it's usually preferable to take cash and walk away, but if the other company is a high flyer, maybe Tesla's buying you and they're going to give you Tesla stock and you're a big believer in Elon Musk, maybe you really like the idea of not getting cash but getting Tesla stock. That would be worth it to spend the money on your diligence team going on offense. I always use the terms defensive due diligence and offensive due diligence. Defensive due diligence means, as the seller, I'm thinking about how to respond to the buyer's requests. When I'm on offense, the seller is looking at the diligence that the buyer needs to provide us to make sure that we're comfortable taking their stock or that they can fulfill their financial obligations. So sometimes you really do, as a seller, have to do diligence on the buyer. I hope this was helpful and that you enjoy our other videos. Thank you.